today's class are related to enhanced knowledge and skills of AIU students. We will talk about difference between finance and accounts, about financial planning, what are the functions of financial management, financial analysis, cost benefit analysis, and cost effectiveness. In addition to that, we will be also discussing about internal control, financial audit, budgeting, cash flow, investments, profit maximization. As I mentioned that this is part 2 of financial management, I would like to review a little bit about the structure of today's class and then start the session on part 2. As far as the structure of this class is concerned, I will start with the overview of last class, part 1, financial management part 1, and then make presentation as per class objectives. And during the class, I'll ask different questions from the participants so that they are involved in this class also and they have proper attention towards this class. And for answering your question, please write down your answers in the box of comment in chat. And at the end of this class, there will be a question answer session. That means we will have questions at the end of this class. And you can note down your questions, and at the end you can ask the questions. And then we will close. As far as the PowerPoint presentation of this class is concerned, it will be uploaded on the AIU system. And the participants will be having access to that through AIU system. As far as the overview of last class is concerned, basically we discussed about the financial management. What is financial management? Like we said, it is about planning investment, funding the investment, monitoring expenses against budget, managing gains from investment to achieve the goals. Like general management, we also keep and set goals, financial goals, and then accordingly with the financial management, we achieve these goals. Financial management means management of all matters related to finances. And the general management principles are applied to the financial management. When we talk about management, you must have heard about planning, organizing, leading, controlling. All these terms, all these management terms are also used in the financial management. And in the last class, we discussed about different terms. Those are used in the financial management, objectives and principles of financial management. We discussed about the phases of financial management cycle and the scope and importance of financial management. We initially discussed about cost benefit analysis, but in detail we are going to discuss it in this class. And in the last class, we discussed about the role of finance team. What is the role of finance team so that they achieve their financial goals? and what are their responsibilities. So that was the overview of the last class. And now we are going to start personal financial management part 2. As I said, according to the objective, I'm making this presentation, and we will start with few financial terms. Those you will see during my presentation, and we will talk about these terms also. I thought we should initially see what are these terms. So when we discuss, we know these are the financial terms. Financial terms are related to assets, liabilities, tax planning, loss. These are the terms those are used in the financial management. Cost, benefit, financial statements, plan, goals. As I mentioned, in the general management, we set goals. In financial management, we also set goals. Investment, benefit, financial planning, audit, risk. These are some of the terms. Those will be those we are going to discuss in this class in line with the objective of this class. Now we will talk about finance and accounts. The purpose of this slide is to discuss about what is finance and what is accounts and what are the differences between these two terms. In fact, finance is investing, borrowing, lending, budgeting, saving, forecasting for personal financial matters, for corporate, for the government. As far as the accounts is concerned, account is the process of tracking and recording financial activities, such as any money coming and money going out and producing periodic statements. So basically, briefly, this is difference between finance and accounts. And now we come to the financial planning. So that we are clear, like in the management terms, we use planning. So in finance, we also use this planning term along with financial management. This function, as you know, this function involves setting financial goals and creating roadmap to achieve them. How we are going to achieve? It includes development of budget, forecasts, cash flow, and financial plan for the short-term and long-term future of the business. Step by step, we are going to discuss these terms in detail, like as I mentioned about cash flow. So we are going to discuss it in detail during this class. And the characteristics or the features of financial planning for firm and individuals. Foresight risk. The financial plan should forecast all the risks those could be faced during the process of implementation. Especially when we talk about financial management, we refer to like when you make investment, there are always chances of loss. So in advance, what could be the risks so that those could be mitigated? In fact, we cannot control all the risks, but we can foresight and as well as we can plan how can we mitigate these risks. Flexibility to adjust. During the process of financial management, like monitoring we do in management, same is the case in financial management. We monitor and accordingly the plan should be flexible so that adjustments, the needed adjustments could be made. And best use of funds. That is mostly related to like cost benefit analysis and the maximum profit maximization. How can we get maximum profit out of a business? And the plan should be very simple. The financial plan should be very simple so that everyone who is involved, all the stakeholders are able to understand it. It should not be so complicated so that uh, anybody cannot understand or the implementers face problems while implementation. Cash availability, this is the most important thing, and as well as like cash flow. Uh, this is again relates that for meeting all the expenses, there should be enough cash at the right time so that all the due payments are made. And again, before that, what are the sources of revenue? How are we going to receive that cash so that these payments are made on time? This is part of financial planning and focusing on goals. The plan should focus on financial goals, those were set. So at the end of uh, the business or at the end of planning period, these goals are achieved accordingly. In business, when we talk about focusing on goals, mostly uh, in terms of financial management, it is related to profit maximization. There are different approaches and methodology of financial management. It is a continuous process that contributes to the overall objectives of the organization. It involves continuous planning, monitoring. We cannot say that we have prepared a plan and we are implementing it. We need to monitor the plan that whether all the activities those were planned are being implemented accordingly, like the availability fund or the revenue, and if need be, adjusting strategies in response to changes in the business environment. The plan, like in the beginning, I mentioned that it should be flexible. We should have flexibility in the plan uh, so that in terms of need, in terms of business environment, it could be adjusted accordingly. All the actions needed to achieve the financial goal must be taken into account. Now, here's a question from the participants. It says, financial goals are set at the planning stage. Financial goals are set at the planning stage. Is this true or false? Please write down your answer in chat. Now, as far as the answer is concerned, it is true. In fact, financial goals are set at the planning stage. Like in the general management, we set goals. Same is the case in the financial management. At the planning stage, all these goals are set. Now, we will go further down. Functions of financial management. Now we are going to discuss about the functions of financial management. It is the practice of handling finances and applying different management principles in a way that allow to be successful and compliant with regulations for achieving financial goals. Now here, the key word is regulation. In the financial management, there are different internal controls and rules are set for implementation for functions. The functions, as we started discussing about planning, it is related to capital budgeting, financial analysis, risk management, working capital management, financial reporting and compliance. We will discuss in detail in further, but these are the major functions: dividend policy, cost management, financial control and auditing, financial forecasting, performance evaluation, investor stakeholder relations. Now we will talk about capital budgeting. In fact, capital budgeting involves evaluating and selecting investment projects that will yield the highest return and create value for the business. This includes decision about acquiring assets, expanding operations, or launching new projects. And as far as financial analysis is concerned, the financial team is responsible for analyzing the financial position and performance of the business. This includes assessing financial statements that helps to analyze, conducting financial ratio analysis, and using various financial metrics to evaluate profitability, liquidity, and solvency. Risk management. In the beginning, I discussed about this term that when we talk about financial management, we try to manage the risks. The risks are always there. It is the continuing process to identify, analyze, monitor, and evaluate potential risks in advance. This is all is done in advance for taking precautionary steps to mitigate. As I mentioned, we can mitigate, we cannot control, but we can mitigate the risks and the adverse effects of loss. This is called risk management. Working capital management. Managing working capital involves overseeing the day-to-day liquidity and cash flow of the business. It includes managing assets, For example, inventory, accounts receivable, and liabilities, accounts payable, to ensure the organization can meet its short-term and long-term obligations. Dividend policy. It is related to the decisions related to dividend payout to shareholders are a part of financial management. These decisions are influenced by the company's profitability, capital needs, and shareholder expectations. Cash management. Managing and controlling cost is crucial for profitability. In fact, when we talk about profit, it, it depends how much cost is involved and how efficiently these costs are spent so that maximum profit is gained. Financial team works to optimize cost structure, identify areas for cost reduction, and ensure that resources are used efficiently. The major emphasis is on the cost management so that it is used efficiently. Now, here is a question from the participants. The management principles are not applied in financial management. I repeat, the management principles are not applied in financial management. Is this statement true or false? Please write down your answers in chat.
Almost almost all of the answers are false. Only a couple students have said true.
Very good. You're right. The students are right. It is false because in the beginning we said the management principles are applied in financial management. That's great. Now we will discuss about financial control and auditing. It is establishing internal controls and conducting regular financial audit are necessary to prevent fraud, mismanagement, and errors in financial reporting. Until unless we have proper control and we have proper auditing system, we cannot say we are managing our finances. And these are the most basic and important functions related to financial management. And now, what is financial forecasting? Financial management use forecasting techniques to predict future financial trends and conditions. This information helps in making informed decision about resources allocation and financial strategies. Proper allocation is made and strategies are developed accordingly. Performance evaluation. Like in general management, in the financial management, we also talk about performance evaluation. Financial management involves evaluating the performance of various business units, projects, and investments to assess their contribution to the overall financial health of the company. Financial analysis. This includes assessing financial statements, conducting financial ratio analysis, and using various financial metrics to evaluate profitability, liquidity, and solvency. All these are set and they are standardized in financial management. Financial reporting and compliance. Reporting is a must requirement and compliance of all, all the procedures, systems. That means preparing financial statements in accordance with accounting standards and regulatory requirements is essential. It must be ensured that the organization complies with tax laws, reporting regulations, and other financial disclosure requirements. As far as the disclosure requirements are concerned, these are, we can say these are related to tax and proper information and timely information to the shareholders. And with the help of reports, this could be done. Investors, stakeholders relations. In financial management, the relationship also matters. Building and maintaining positive relations with investor and shareholders is essential. That means there should be a proper communication system so that all the relevant information, may it be in terms of financial reports, statements, would be timely and accurately or as per requirement be shared. Financial team communicates company's financial performance, strategy, and outlook to investors, analysts, and public. So that means all the stakeholders must be in contact in order to share all the relevant information. In the last class, we discussed about cost-benefit analysis briefly, and today I'm going to discuss it in detail, a bit in detail. And I'm repeating, like, a cost-benefit analysis is a systematic process of comparing the projected or estimated costs. What could be the costs and what are the benefits or opportunities associated with a project decision to determine whether it is economically beneficial or not. All these analyses are done for making the investment or making any expense. Cost effectiveness. Benefit could be if it is cost effective. A cost effective analysis focuses on the outcome and see how much spending is needed to bring about that outcome. It helps in decision making to allocate limited budgetary resources. All the time, you have a budget, and you cannot make over expenses, and you have to be within the budget so that maximum profit could be gained. These are the ways in order to assess and analyze. It is commonly used in healthcare, for example, where it is difficult to put a value on outcome, but where outcome themselves can be counted and compared. For example, the number of lives saved. Whereas cost effective analysis and cost benefit analysis. Cost effectiveness analysis is distinct from cost benefit analysis, which assigns a monetary value to measure the effect. Internal control. Now we will talking about internal controls are the mechanism, rules, and procedures implemented by an organization to ensure the integrity of financial and accounting information, promote accountability, and prevent fraud. For all, internal control is the basic and essential requirement, and all the regulations are written, documented. These written regulations outline who in the organization is in control of and authorizes financial decisions. Procedures. These are the most essential scope of financial management. Financial data, including invoice, payments, and reports, are prepared and communicated by the finance department in accordance with policies established. There are set procedures according to that all the financial data and invoices, payments, reports are processed. All these processes should be followed according to the procedures and the policies. Financial audit. You must have heard this term many times. In fact, a financial audit is an objective examination and evaluation of the financial statements of an organization to make sure. The emphasis is making sure that the financial records are a fair and accurate representation of the transaction. That means it is confirmation of all the receipts and the payments those were made are fair and accurate representation of the transactions they claim to represent. And for that matter, different verification methods are used at the time of financial audit. budgeting. Normally, we use this word budget. It is, in fact, related to estimation of revenue and expenses. It is not only the expenses that much amount will be spent. No. Budget is estimating revenue as well as expenses both over the specified period of time. It is evaluated on periodic basis. Its evaluation is related to that, for instance, a certain amount is fixed for X cost, and now it will be evaluated whether the amount was spent within the budget or it was overspent. If it was overspent, different questions could be raised, and there should be logic so that the adjustments, if need be, could be made within the budget by reducing other costs. But the limitation remains there. You have that limited amount. You cannot say that you can increase the amount unless the source of income, the revenue is increased. So in that case, this evaluation is very much required. And it is done on a periodic basis. That could be, for instance, this much is the monthly budget or the quarterly budget. Are we making the expenses or we are receiving the amount which was budgeted? So it is evaluated according to that. Now, I have a question for you. Cost effectiveness analysis and cost benefit analysis are the same. Cost effectiveness analysis and cost benefit analysis are the same. Please write down your answers in chat.
Everybody has said false so far.
Okay, let's see. B, false. Great. Cost effectiveness analysis and cost benefit analysis are not the same. Right, false. So we move on. Cash flow. We have used this word many times during this class and in the last class. So what is cash flow? Cash flow is the increase or decrease in the amount of money a business, institution, or individual has. Cash flow is heavily affected by all business decisions and must be taken into the account all the time. That means you know from where you are going to receive and how much you are going to receive and how much you need to pay so that all the cash transactions, whether these are receipt or payment, are made timely or according to the budget. You must have cash in order to meet all the expenses as planned. And same is the case is the receipt. You must have planned for the receipt that gives the source of receipt from where you are going to receive and how much amount are you going to spend. And it is all reflected in the financial statements. As far as the cash flow statement is concerned, a cash flow statement is a financial statement that shows how cash entered and exited an organization during accounting period. So you know, with the help of the cash flow statement related to all the receipts and expenses, accountants use these statements to record, track and report transactions. As we discussed about the statements, cash flow is one of the financial management statement. And now we'll see what is the difference between cash flow and fund flow. Cash flow is based on the concept of outflow and inflow of cash and cash equivalents during a particular period, whereas fund flow fund flow is based on the concept of changes in working capital over a period of time. Assets decisions. This is the most important aspect of financial management. Like for every kind of business, assets are needed, but the decisions related to how much and what type of assets are needed to acquire. Assets means what I own, like cash, receivable, securities, share, bonds, computer, furniture, car, machinery, and building. Again, while making assets decision, the cost benefit analysis is used. Saving and investment. Saving and investing are essential for building wealth and securing one's financial future. As far as saving is concerned, it involves setting aside a portion of income for future use. Like you save money for your retirement, for example. You set aside a certain amount. An investment, it entails allocating funds to various assets to generate returns. This is the major difference. Profit maximization. Profit maximization in financial management is the primary objective of every business. It represents the process or the approach by which profit is increased. Different strategies are developed, alternates are found in order to maximize the profit with efficient and effective investment. All the decisions, whether investment or financing, focus on maximizing the profit to optimize level.